Welcome to My Steel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. I'm Nikki Fu, Commercial Director at My Steel Global, and with me, as always, is Gary Gao, Gas and LNG Markets Research Lead at My Steel Oil Chem. For the week of August 14th to 20th, China's LNG market really turned a corner. Ex-plant prices climbed to around 5,540 yuan per ton, market prices pushed up near 5,830, and receiving terminal prices followed too. Feels like a different market from a few weeks ago.
It really does, Nikki. And honestly, it wasn't just prices drifting up. You could feel the mood shift. Traders went from wait and see to actively chasing the rally.
Yeah, that tracks with what we were hearing. A few trading houses were reportedly sitting on cargoes rather than selling into strength, which is very much a buy the rally, don't sell the dip mindset.
Exactly. That's the phrase I'd use for it.
So, what actually lit the fuse here? My read was it started on the cost side, not demand.
You're right, it did. PetroChina ran its usual feedstock gas auction, the raw gas plants bid on to actually make the LNG, and it cleared a few cents higher than the round before. That instantly raises the floor on what it costs plants to produce.
For anyone less familiar, think of that auction like the crude oil cost for a refiner. Plants, mostly up in Inner Mongolia, bid for that raw gas, and whatever price clears becomes their input cost.
That's a good way to put it. And when that number creeps up, it's not really a demand signal, it's a cost signal. However, LNG prices are so sensitive to production cost that the market reacts to it almost like demand news anyway.
Here's what surprised me though. Margins actually improved despite costs rising. Average production margins in Inner Mongolia were still negative, around negative 96 yuan per ton. But that's a good 47 yuan narrower than the week before.
Yeah, that one threw me a little too at first. Plants were still losing money, just less of it, because selling prices climbed faster than feedstock costs did. A few plants that had cut output because they were bleeding, cash started dialing back up again.
Which lines up with what we saw on the production side. Output ticked up to around 539,300 tonnes for the week, a bit over 0.5% higher, and utilization edged higher too, even with some units still down for maintenance.
Right, repaired units coming back online outweighed the new maintenance going offline, so it nets out slightly positive.
Now, the number that really jumped out at me was arrivals. Imports nearly doubled, about 1,720,000 tonnes landing versus about 880,000 the week before.
I'd flag that one before anyone reads too much into it, though. It's mostly a scheduling quirk. A bunch of previously booked cargoes from Australia, Malaysia, and Russia all happened to land in the same window. I wouldn't call it the new normal. Expect that number to cool back down.
That's fair, and interestingly, even with all that extra gas hitting the docks, plant inventory still edged down rather than building.
Exactly. And that's honestly the more telling number to me. It tells you demand was real, not just prices chasing costs.
Consumption was up close to 6% on the week from what we tracked. More trucking activity, gas stations busier, and buyers front-running expected price gains.
That lines up with what I was seeing too. So even with more supply landing, it got absorbed fast, and plant stock still came down.
Let's zoom out a bit. How much of this is China-specific versus the global gas picture? We saw Brent crude firm up as well, close to $90 a barrel.
There's definitely a global layer. That move in Brent was tied to shipping risk concerns around the Strait of Hormuz, and it bled into gas sentiment generally. European gas benchmarks climbed too, on worries that storage refill there isn't keeping pace with the season. None of that sets China's domestic price directly, but it shifts the mood. China's domestic traders were already holding back cargoes on a buy-the-rice mindset, and reduced Hormuz Strait traffic was pushing up speculative trading internationally too.
So, tighter market for real or more of a short-lived spike?
My understanding is we're heading into the seasonal demand window, what the industry calls golden September, with a genuine cost floor underneath price now. If that feedstock cost sticks, and demand keeps building the way it typically does this time of year, there's a decent case for prices to keep grinding higher, just not at last week's pace.
Which brings us to the forecast. Looking ahead, ex-plant prices near 5,550 yuan per ton upcoming week, and market prices around 5,850 yuan per ton. What's driving that call for you?
I'd watch three things: whether more plants come back online from maintenance, how fast inventories keep drawing down, and whether that arrival surge normalizes like I expect. Put those together and I land in roughly the same range you just quoted, a gentler climb than what we just saw, but still up.
Gary, thank you for sharing your insights, and thanks to everyone for listening. If you'd like to follow these developments in more detail, the full analysis and data behind today's discussion are available through MySteel Oilchem's latest China LNG Market Weekly Report. For more information, please visit mysteel.net or contact us at inquiries@mysteel.com. Thanks for listening to MySteel Commodity Flux. If you found today's episode helpful, be sure to subscribe for more analysis on global commodity markets. Until next time, keep tracking the flows.